guys, it's Chad Larson with MLD Wealth. This is going to be a little special interjection of a quick podcast, given the volatility that we've seen in the market over the last three trading sessions. So I just published, our monthly podcast just a few days ago, but I thought it was timely. I sent out a physical note to clients here this morning. But boy, oh boy, this is pretty wild, and so this is absolutely worthy of a communication to get out there as fast as I can. My phone's not ringing off the hook, but imagine that's around the corner. Listen, markets don't like surprises, and last week's Liberation Day tariff announcement was no exception. The reaction across global equity markets was swift and negative as investors recalibrated their expectations in real time, with key global markets down over 20% from their highs in a matter of days, including the NASDAQ US, the DAX, the German exchange, and the Nikkei in Japan. A significant amount of bad news has already been priced in. While markets could decline further in the event of recession, it's important to recognize that changes in policy could quickly halt or even reverse some of the recent damage. Listen, I can't speak to the exact mechanisms of the thought processes of Donald Trump, but he's a businessman. You have to look more at what he's trying to accomplish instead of what he wants, what he's actually saying. He's asking countries to come and negotiate. And I referenced this in last podcast, he feels that the global economy has had too much of an unfettered access to the largest economy in the world, the U.S. consumer. And so he announced, sweeping tariffs to raise a significant amount of capital to balance trade surpluses. For example, but you have to understand how volatile markets can be. Last night I had indigestion going to bed. The overnight futures market opened up, and listen, the S&P corrected 10% in 2 days, Thursday, Friday. It was an absolute bloodbath on the screen. And the futures were off another 5% in overnight trading. And then they opened up only off 2%. So session lows, it was minus 4.4 for the Dow, minus 4.7 on the S&P, minus 5.2 on the NASDAQ. But the S&P's rallied off that bottom and is only off just over 1%. And these numbers are like they're changing by the second right now. Overnight, Japan, the Nikkei was down over 7 in the Hang Seng. The Hong Kong market closed off down 13.22%. This is when you want to thank process and discipline and have no leverage and ample liquidity and diversification. So I remember what we own and what we're positioned in, and I went to bed feeling fine. So while uncertainty is running high, we believe there's a reasonable chance that policymakers could soften their stance in the months ahead. However, rather than making assumptions, we remain fully committed to a disciplined risk management approach that prioritizes capital preservation while positioning our portfolios to capitalize on market dislocations that volatility tends to create. So how are we positioned? Leading into this period, we've been active within portfolios, tilting away from growth and increasing exposure to credit, accounting for both the uncertainty surrounding global policy decisions and our assessment of market valuations. This discipline is reflected both in our credit quality and our liquidity profile, offering flexibility and stability when markets become unsettled as they have this week. We don't use leverage. Leverage in the system exacerbates volatility and causes more pain, as people are inherently always more tolerant of upwards volatility and not forced to sell. We apply stringent risk controls to prevent leverage from being used to chase returns, and our disciplined risk management prioritizes liquidity, diversification, and stress testing under various market scenarios. The result is a risk-adjusted approach designed to navigate volatility. So while sharp market moves can be unsettling, they also present incredible opportunities. Dislocated markets often lead to mispricings that active managers can take advantage of, whether through rebalancing, selectively adding exposures where the market has overreacted, and capturing attractive credit spreads. We're already seeing compelling opportunities emerge, and our focus remains on positioning portfolios to benefit from market inefficiencies while maintaining a strong risk foundation. So staying steady in turbulent times, as we navigate this evolving landscape, our investment process remains anchored in rigorous risk management, strong partnerships, deep research, and long-term perspectives, principles that guide us through both calm and stormy markets. So these moments of volatility, while challenging, reinforce the importance of active and disciplined approach to rebalance portfolios and capture these dislocations. Market swings come and go, but discipline, patience, and a steady hand always endure. As always, we're here to answer the questions you may have, and if you'd like to discuss further, more of our outlook and how we're positioned for the road ahead, do not hesitate to reach out. We aim to continue to providing strong risk-adjusted returns no matter the market environment. I have a few points here. Everyone wants to know exactly what we think will happen. I thought this is a bit of a these are scenarios, and it's a bit of a tough read. There's some negatives, there's some positives, but these are scenarios that we could go through. The historic book suggests more pain. The S&P's minus 17% peak to trough sell-off is unremarkable in historical context. With a negative 49% peak to trough sell off in the .com crash, a minus 57% peak to trough move in the great financial crisis, a minus 34% peak to trough move during COVID, and in the period of history being the most closely linked to today, a 25% sell off in the first 2 years of Reagan's first term before an approximately 180% gain from November of 1982 to November of 1986. That's one outlook, one scenario. We get the bounce tomorrow. The best thing investors can do now is wait for some clear signs of exhaustion to show up, which would give more evidence of some form of low being in the making. The good news is that those signs are not far off. By tomorrow, we could finally get the first clear buy signals on the S&P and the NASDAQ. This would require another low tomorrow as well, but we have that right now. This was as of last night, but it would be in the case of the S&P finally completing the first two sets of buy signals, which people wait for. This one is probably my favorite, and I hope this one happens the most, but Trump could back down. Base case is Trump will need to back down over the coming days, but in a way that he can still claim victory. Equity ownership is high in the US, and several senators and House representatives have large equity portfolios, and people like Ackman and Druckenmiller have been getting more vocal. Trump's administration reaction is much lower, if there is one. Some interesting dialogue over the weekend. Per Besant, Lutnick, and Navarro's media interviews over the weekend. In Besant's interview with Tucker Carlson, he highlighted the rationale for tariffs. Tariffs are squarely aimed at benefiting Main Street versus Wall Street and incentivizing domestic manufacturing and generating significant revenues, somewhere in the neighborhood of 300 to 600 billion per annum. And the administration is very confident that China can't survive without access to the U.S. market. Another one is that the U.S. positioning unwind has barely begun, and that is in the face of still elevated valuations. The S&P at 20 times forward month consensus earnings, weaker revisions and momentum versus the rest of the world. I'd mentioned you would have started to tilt away from momentum and growth in the U.S. and looking externally at the U.S. for opportunity. In the context of that, in 2024, 40% of the gains came from just multiple expansion. Just companies being traded higher, regardless of their earnings revisions. So that's one of them that the market needed a big correction. But we see job numbers looking great. Corporate balance sheets are in phenomenal shape. Another one is that concentrated risk is still elevated and worries about waterfall equity declines. And what I mean by that is, given the explosion of passive investment in recent years in the U.S. via index tracking ETFs, this means everyone owns the same stocks. Example is total assets in all S&P ETFs traded in the U.S. surged from $935 billion at the end of 2022 to a peak of almost $2 trillion on February 18th, and have since declined to 1.8 trillion. A Fed put or some interaction by the government would be needed to stop this. Potentially you could see an AI bubble bursting, with the four major hyperscalers still guiding for almost $320 billion of capex this year. Such an outcome almost seems inevitable, which would result in a bearish implication for the stock market, which has been so tilted to technology. Equity valuations. The S&P guys have mentioned, 19-ish times 12 months forward earnings it's down 3.5 full points from its February peak, but it's only back to where it was in January of 2024. In 2002, the S&P traded to a low of 14.2 times its next year's earnings. In 2008, when the country was in severe recession, and it was the great financial crisis, that figure hit 8.8 times earnings. And during COVID, we saw the S&P forward multiple dropping to below 16. And will the Fed step in? It doesn't look like it. Powell was out on Friday with more of a hawkish message than expected. The clear conclusion is that the Fed's reaction function for the time being is heavily skewed towards inflation control rather than growth protection. Traders, of course, want to beg to differ. In the financial futures market, they have sharply boosted their expectation for the number of cuts in the federal funds target to more than 5. I don't know whether you want to call it conspiracy theory, but one of the kind of consensuses that I hear a lot is, and you saw Trump's kind of coy reaction to reporters asking him of, what he thought of the tariffs causing a stock market crash. There's a massive amount of treasury debt that needs to be refinanced this year. This is a wall of treasuries that need to be refinanced out that were done when interest rates were at near 1%, and the 10-year treasury is hovering around 4. Is he causing a short-term crash to the market to force the Fed to drastically cut interest rates so that he can refinance that debt? If it happens fast and severe and the Fed takes the bait, this could be the best play you've ever seen. This could refinance a significant amount of U.S. federal debt, at much lower rates. And if it's during a short enough rut where there's not massive job loss and a deep-rooted recession, and corporate balance sheets remain robust and corporate earnings continue to look robust, it will be the trade of the century. So, we'll see. So, we've seen a massive, futures traders have sharply boosted their bets on the Federal Reserve to cut interest rates this year amid rising economic uncertainty. Will Powell do this? That's a lot. I think the best thing investors can do now is to wait for some clear signs of exhaustion to show up, which would give more evidence of some form of low being in the making. And the good news is those signs are not far off. Tomorrow I think could even be one of them. Again, I referenced what Trump, what he wants to do versus what he says. And, more than 50 countries have now initiated tariff negotiations, but there will be no quick resolution. I think it was Reuters cited the U.S. Treasury Secretary Bessent and other Trump advisors, noting that more than 50 countries have now approached the White House to begin new tariff negotiations. So no details about the countries involved or content of the talks, though the article noted simultaneous negotiation could pose obviously a logistical challenge for the administration and prolong economic uncertainty. They downplayed the stock market drop and said there was no reason to anticipate a recession based on tariffs, citing stronger than anticipated U.S. job growth. And what happens, kind of look to history to look to the future, and what has happened in other times where the S&P, after falling 10% in or more in 2 trading sessions within 2 months of all-time highs. So when has this happened before? This happened in 1929. This happened in 1987. This happened in 2020, and now it's happening in 2025. What I can tell you that other than the 1929 in the Great Depression, the market 12 months after this has looked significantly higher. 12 months after, in 1987, the markets were 22.9% higher. In 2020, the market was 59% higher. So with this unprecedented sell-off and volatility across global markets, we remain fully focused on monitoring and proactively managing positions in real time. We're in constant contact with management teams, portfolio managers, and ownership over our portfolio of investments across all asset classes. And remember, we don't just own a bunch of tech stocks on the NASDAQ. Our strategies are defensive and diversified and focused on high-quality counterparties. In credit, our investments are in senior in the capital structure of large established businesses and industries. Our direct lending vehicles are well diversified, further isolating the impact of one-off portfolio company issues. The vast majority of our counterparties and partners have the scale and breadth that can help them navigate uncertainty. Structural subordination can insulate the value of our invested capital, which can help protect our clients from downside risk. Looking at some of our credit business, our investments have very low LTV or loan to value. This implies that on average, a borrower would have to lose significantly all of their value before we could see any impairments. The portfolios benefit from lower correlated assets as well. As we know, we're big proponents of alternative assets. Alternatives can, um, with that low correlation to traditional asset classes like stocks and bonds, can help reduce overall portfolio risk. By reducing exposure to public market volatility, we can stay invested in times of uncertainty. So, by seeking to deliver consistent income and more stable returns, strategies like private credit, equity, real assets, infrastructure, and real estate can help smooth performance during periods of public market turbulence. So, our investment strategies are focused on providing creative capital solutions to large creditworthy counterparties. And in times of volatility, we believe the scale, speed, and certainty of our capital separates us from our competitors to generate value for our clients. So we remain cautious about the potential ripple effect of tariffs and their impact on our portfolio companies, particularly the possibility of broader recessionary pressures, impacts on customer demand, supply chain disruptions, and overall business operations. However, we believe, with respect to Alterna, is well positioned to navigate these challenges with our scale, conservative portfolio construction, deep relationships with sponsors and banks. We believe we're well positioned to navigate uncertainty more effectively than traditional public market strategies. Listen, guys, during times like this, our top priority is to support you and keep you informed. If there's any questions you may have, feel free to send me an email, give me a call, or any member of MLD. With that, I hope to come to you in a few weeks with next month's podcast and give you a better news. But it's volatile out there. Stick to your people, your process, and your philosophy, and try to avoid panic where it ensues. Have a wonderful day, and thank you again always for your unfettered trust and confidence in helping you navigate financial markets. Take care.